As we see all the big firms such as Blackstone, Apollo, Goldman Sachs launching their university, I think today I'm speaking to someone who has defined what it means to properly educate investors in this alternative space. Leyla Kunimoto, very pleased to meet you.
Thank you for having me, George. It's a pleasure.
So Leyla, I know you from your writing at Accredited Investor Insights, and I think, well, that title tells us a lot about what it does. But can you tell us a bit more about this newsletter and what the goal is and what brought you to this idea based on your background?
Yeah, so I started this newsletter about a little over a year ago. And what originally the idea was to share the knowledge that I see. I'm an individual investor. I invest in private markets. I've been doing this for about 5 years. And what I saw in the marketplace is I didn't see any information that was targeted towards me. There's a lot of information that comes from sponsors, and a lot of it is high, good quality content. But there is nothing but, of course, sponsor content has a certain tilt to it. And I wanted to have, I was looking for a resource that would give me an unbiased opinion about certain things. So the newsletter was launched and we joke about it, we see the democratization of private assets coming to retail investors, but the information is not democratized. There's a huge imbalance. Sponsors have a lot more information than investors do, and investors have a really difficult time accessing that information. So out of that, the newsletter was born, and it's been a huge success. It's been out for a year. I write about what I see in the private markets. I write about trends that I'm spotting. I bring guest authors on various deeper topics. And yeah, that's basically in a nutshell.
Yeah, we'll dig further into that, but you already hit a lot of very important points. This is democratization of finance. Also something that we discussed with a previous guest, Bill Kelly.
I still think I'm hardwired to be involved in the discussion, in the dialogue, and trying to put democratization and education before product is placed in front of the client. Very simple value proposition, difficult to do.
Who, I will not quote him exactly, but he says that, the democratization of knowledge has to go before the democratization of the product. And this democratization itself is something that is contentious in my mind. And just like also the fact, I poked them a little bit in the introduction, the Goldman University, the Blackstone University, I found it quite funny when you are not allowed to call yourself a bank, and many people have tried and have been, regulated with that. But apparently you're allowed to call yourself a university. So anyway, just a little remark like that. You're laughing, but I think what you're doing is really useful information, the type of things that I've been looking for in my exploration of private markets. And can I understand a little bit more about your audience? So you talk about private investors, but are LPs?
Yes, the information is intended for people in my boat, private limited partners, investors who are individual investors who invest in private markets. But what I've been noticing, the trend, it's almost from the get-go, a lot of the audience has been shifting towards money managers, allocators of capital, RIAs, wealth managers. I think the reason why is because I am the bottom link of the long chain, right? We have fund managers who roll out funds, who raise capital. A lot of those larger fund managers go and do that through the wealth management channel. The wealth management people are sort of, they sell those products, right? They're educated on the products and they sell them. I am the avatar, not me personally, but people like myself are the intended customer. And there's really nobody else out there, or not that I can find somebody who writes about this publicly. So I think that is the reason why a lot of the readers are now, it's always been a good percentage of my readers are actually people who would sell the products to me.
And professionals. But it's also interesting, just even if, they might not be your exact audience, this concept of retail LPs, because there's this whole access for feeder funds, for evergreens, etc., where you don't need to be an LP, right? Mm-hmm. If you're an LP, you kind of have a seat at the table. You talk with the GPs. And I think that's something a little bit almost paradoxical in terms of this retail LP, right? Because from what I gather in your newsletter, and I'm an observer, not a player in that game, but I spent a bit of time looking into it, understanding it. It's bloody complicated. There's a lot to learn, right? I guess my question is the space there for tourists or amateurs that go in this professional league. I'm trying to figure out who they are.
Yeah, so I am seeing, and I know hundreds, probably over 1,000 investors who are like myself. There are a couple of common ways how people end up doing private markets, accessing private markets. And over the years, over the last 5 years, that access has broadened quite meaningfully in front of our eyes. So, the one path is through the wealth managers. Somebody gets an RIA, and by default, they start allocating some of those RIAs, discretional. So, some of the RIAs, and there's gradations to how involved the actual investor is decisions. Some investors are quite involved, and some, they will call their RIA and say, hey, there's an XYZ secondaries fund. I would like to allocate to that. Do it for me, right? But then there is another way, and that's how I actually started. The lower end of the market, GPs who are a little bit newer, who are not institutional level GPs, those GPs, those general partners, work with investors directly. So an LP, a limited partner, like, an individual investor, can come and say, okay, I like the deal that you're syndicating, or a fund that you're syndicating, let's go ahead and invest. And on that end of the market, you have direct access to the GPs. Yes, you get them on the phone. Size-wise, it's probably up to maybe 250 million to maybe 500 million for a fund manager. Up until about that point, you have direct access. Somebody who manages $2 billion worth of assets is going to have sometimes those fund managers do work with RIAs, but sometimes they still work directly with investors. So once you get into the Blackstones and the KKRs, the access, there used to be like, you don't get the GP, you do not have any sway, you don't have any negotiating power.
No, that's a very interesting nuance that you're bringing here, because we think about PE, private assets in general, and those names like Blackstone, KKR, etc. That's exactly what we think about. But what I realize, it's a very different game. It's also perhaps a little bit more towards the real estate space than the equity space, where you can also have more tangible things in terms of the asset that you're going to be discussing and things like that.
So that real estate, for a lot of people, is sort of the gateway drug into private placement. A lot of people understand it. It's much easier to find fund managers who syndicate real estate, who do single individual deals. It's also a lot easier to find GPs there's a lot of GPs who will have, $50 million worth of assets, and they go and raise outside capital. Private equity is a lot more skewed toward the larger fund managers. So on the range of, here's the smallest fund manager and here's KKR, a lot of people start here, unless they go through the wealth management channel. With, if you have an RIA, you very likely will enter private placement via an interval fund. Something like, I'm not going to name names, but there are a lot of people, I know a lot of investors who get an RIA recommends that particular fund for a variety of reasons. Boom. You're now allocated to private placement.
As I look at this space, I think what you're observing is something that is easy to miss when you're having a broad conversation about those private assets, is that it's a very different approach. And I look at it from the individual investor point of view, in terms of the commitment, not so much in money, but in terms of time and personal effort into it. What you're describing is a very, very different approach, and perhaps more entrepreneurial in terms of you're putting not just your money in the game, but putting your, well, whatever, brain or involvement.
It's absolutely correct. So let's talk about professional LPs, right? Institutional LPs. Let's say an endowment fund for a university will have people who are trained to, professionals, right? Somebody with a degree in finance who is thinking about allocations. It's their full-time job to kind of interview GPs, look at the different fund offerings, think about it in terms of, does it fit our investment strategy or not? So institutional LPs have that. Retail LPs are tasked with the same level of diligence, but a lot of retail LPs fall into one of two buckets. Bucket number one, high income earner, who is trying to diversify out of the S&P 500 and get, illiquid assets, right? Another profile is somebody who exited a business and they have a bucket of capital that they need to allocate, and perhaps that bucket is not sizable enough where they can go and start a family office, right? So they need to do the same, and the burden is on the LP. LP needs to do the due diligence, right? For me to be well diversified and have, let's say, 20 different funds in my portfolio that are hopefully not too correlated to each other in different asset classes, can you imagine the level of work it takes? And that's where you hit it on the head, George, by saying, it's a huge time commitment. It is. It's a full-time job for a lot of people. And a lot of people treat it as it's their hobby. They retired, they exited the business, they make this their thing, but it does take that level of commitment. You can't dollar cost average into any of it. You need to do your due diligence, you need to think about it, you need to babysit those K1 forms when the taxes roll in. There's quite a bit of complexity to it.
Okay, yeah, that's it. The hobby part of it is actually very important because obviously you go for the returns, but there's this paper about the investing beyond returns. There's a lot more going into it, right? We are not investing just because of the returns. Let's throw in social, intellectual in the mix. That's also what investing is about, even if we don't necessarily express it, and we only express it in a rational way.
For sure. The returns part is questionable. I think we just don't have enough data. It hasn't been long enough. This universe was kind of democratized in the US. It was the Jobs Act of 2017 that kind of brought this to the masses. And we just simply don't have enough data to tell how good the returns are. There is definitely, since 2017, I can guarantee you S&P 500 has outperformed private markets for sure, but this is too short of a time frame, right, to derive meaningful data from or meaningful conclusions from. But it is a huge, there's a huge social aspect. There's also a big component to where it's the bragging rights. A lot of investors will go and play golf with their buddies and say, hey, I'm allocated to XYZ brand name fund manager in their private equity fund, or I'm wiring money into a secondaries fund with ABC fund manager. So there's that too.
And I'm wondering, in the real estate, is there a little bit of this tangible and local aspect? Oh, we're developing this commercial center in my local or extended local area. I can visit it, touch it.
There's a lot of that. And this is why real estate is probably one of the easiest things for people to get into because they understand it. Most of us lived in a multifamily, in an apartment building at some point in our life, right? We kind of understand how the rental, an apartment building is just, you rent out units, you collect rent, you pay expenses, boom, done. It's not very simple. But it's fairly simple to understand the business plan in those. And as far as comparing that to, let's say, venture capital, where you're wiring money into a blind fund, you have absolutely no idea. The fund might be targeting something that's so obscure and so new that nobody knows what the assets are going to be inside the fund. Compared to that, real estate is a lot easier. to wrap your arms around.
Just a quick note for full disclosure. This is where my recording stopped. Thank you, Squadcast. So I'm adding back the questions. And it should feel like a normal conversation. Just ignore that I've shaved and changed my t-shirt. So the next question is, do you have any advice for someone who is interested to get started? What are the first steps?
Yes, so for somebody who has absolutely no background in this, I would suggest that they, and it's easy today. It wasn't quite as easy, a few years ago, but today you can start by getting on a lot of distribution lists, get on some platforms. There are plenty of platforms that post deals, individual real estate deals, for instance. There are plenty of platforms who do all sorts of different asset classes, but specifically for real estate, start looking at deals. Look, you can be in your pajamas on your couch on a Sunday morning, start looking at deals, opening those pitch decks. What I've been trying to do, shameless plug here, but I've been trying to figure out, how do I systematize the knowledge that I have and how do I give it at scale to everybody, right? So I started the newsletter, I write those articles, some of them are pretty technical and they take quite a bit of time and focus to get through. So recently, with the advance of AI, I have developed, kind of a method to the madness where you can upload a deck and have prompt AI to kind of teach you and walk you through this and tell you what the red flags are, tell you what follow-up questions to ask from the sponsor. Because I love the concept of tourism, right? We're all tourists in certain areas. If you're a complete tourist, the first step is acknowledge the fact that you're a tourist, there's just too many unknowns you simply don't know. Start becoming a little bit less of a tourist, right? Start looking at more pitch decks, start looking at what's out there. I would highly suggest that whoever is getting started, that they narrow it down on one asset class. It doesn't have to be real estate, it can be private credit, it can be whatever. I will tell you this, with private equity, you're not going to have hardly as much stuff to look at. It's very opaque. A lot of the companies, you're just not going to, portfolio companies, let's say a fund buys like a bunch of companies, right? Those portfolio companies, you're going to have a very difficult time looking at how those portfolio companies are performing. With real estate, you have very clear numbers, unless you're investing in a blind fund, but you can look at individual assets, pick an asset class, say multifamily. There's a million pitch decks out in the open on multifamily value add real estate. Pick a market and have at it. And then I'm a huge fan of sort of comparison shopping. You can say, okay, I want to look at multifamily in South Carolina. Find every pitch deck on multifamily in South Carolina. You'll find maybe 10 of them. Throw them in a spreadsheet and compare, and that will give you more knowledge than any university online will.
I don't want to dog too much on online learning. Lifelong learning is a wonderful thing. The fact that we can do it like that is a great opportunity, but I think it's also somehow dangerous when it comes to investing. And one of the reasons is that there's a lot of marketing disguised as learning. The shallow learning can be a danger when you think like you're fully empowered and fully knowledgeable, but in fact you're not. And it's very hard to assess without being fully immersed in the first part. And I've seen it firsthand because I followed quite a few courses online. And for example, one of the things that I noticed is that the range of private equity outcomes is always positive, because I guess that's what in the textbook, as if you can never lose money. The reality is quite different.
So let's stick to real estate since we've been talking about real estate. The one thing that I think a lot of investors underappreciate is the fact that in private placement, in equity positions, in a single one-off real estate deal, the probability of a total loss of capital is present. It's present in a much bigger way than it is in allocating money to a publicly or a non-traded REIT, for instance. And there's a plethora of reasons for that. But You can certainly, and there's going to be quite a bloodbath in this space in the coming year or two. But you can certainly allocate into an equity position to an apartment building or an office building and have a complete loss of capital. George, you have a background in finance, and so do I. I studied finance in college, and to this day, it's been 20 some years. To this day, I remember the chart that one of my professors threw up on the board. And the chart was, here's what happens. It was a chart like, here's what happens if you make 5% on your money per year. Here's what happens if you average 8% a year. Here's what happens if you make 20% and then lose 20%, right? And have that intermittent kind of chart where your very large losses are offset by very large gains. In that chart, those losses, I have it seared in my mind because the biggest kind of bomb you can throw into your portfolio is lose principal. And it doesn't matter, especially if the sums are large. And we're talking, you don't need a whole lot of losses to really jeopardize your overall returns because it takes a long time to make up for those losses and your gains. So when I evaluate deals, the only question in my mind I look at is how likely is this deal to go south? And what's the probability of this deal going south? And how is it going to happen? For you to answer the question of how this is going to happen, you need to be not a tourist in this space. I can tell you that for industrial real estate, how it's going to happen in Tulsa, Oklahoma is going to be different than how it's going to happen in Indianapolis. But that's because I have looked at many, many deals in each of those markets, and I have a grasp, and I have a good operating knowledge of each of those markets for that particular asset class. I can tell you that for multifamily in, New York, how the losses are going to occur is going to be very different from multifamily in Texas. This is where you have to be educated. And this is why I highly and very strongly suggest that investors who allocate to individual deals, they start with the education bit. Because one-off deals, you can lose a lot of money in a hurry. And there's a lot of different ways. If you focus on deals that have that wide margin of safety. I'll give you an example. I looked at a multifamily deal. It's in the Midwest, older property, value add deal with a GP who has been churning them out for 15 years. One type of asset, one market. This is all they do. And they have a long track record of doing the same thing over and over again. And they're buying at a good enough basis. And the value add is they can bring those rents up to a level where you can make a lot of errors, and those errors are not going to come and bite you. That's a wide margin of error, and that's a deal that's not super likely to lose money versus a deal that's being bought so expensively and the rents are already at market. There's not a lot of room to maneuver. And then we throw on, really crazy short-term debt on top of it, and boom, that kind of deal will have a much narrower kind of margin of safety and thus higher probability of losses.
Yeah, when it comes to that, I like to reference the late Charlie Munger, who Warren Buffett was calling his abominable no man, because he had obviously a talent for saying no and describing bad deals in such a witty way as he was doing in all those Berkshire Hathaway conferences. But saying no has become a key skill for investors and LPs in particular, because we're potentially being pitched so many opportunities. The access is granted. The skill is to be able to say no when there perhaps are so many marketing arguments that make it look like a shiny object, but you have to look a little bit deeper.
I've never seen a pitch deck that says, hey, we're a bottom quartile manager, but we're awesome. I question how many of the top quartile funds are going to make their way to retail, okay? Because there's a lot of people, there's a lot of money out there that needs to be placed, that's looking for places right now. I hear this left, right, and center, right? There's quite a bit of capital still. Some of that capital is very smart and they know what they're doing, right? They have MBAs from good universities who look how to place that capital. And then you have the retail, the masses of retail investors with their 401ks who don't have the capacity nor the time to do the due diligence nor the knowledge. And yeah, so that's one thing I'm looking at. But then another thing is, with the sports analogy, I learned to ski, downhill ski as an adult. And same story. I'm never going to be as good as my kids. But it doesn't mean I can't learn, right? And it doesn't mean that you can't be a decent skier and have a lot of fun on the mountain. So there's definitely, as a hobby, it's a good hobby. It's just a very expensive one. And if anybody who's inclined to take this as a hobby, I would strongly suggest doing the math in their head and trying to figure out, do I have enough money to play this game? Because to do it properly, there's going to be mistakes, and the mistakes are costly. And to be properly diversified, it takes quite an enormous amount of capital. Yeah, when you look at the pitch decks, every pitch deck that comes across your desk is going to say something along the lines of, well, this is an XYZ deal, it's a real estate, 15% IRR, 5% cash on cash, or whatever. So the pitch decks are not going to vary too much. The devil there is in the details, because some deals are, you can take two of those deals and put them side by side, and they're quite different beasts. Same thing with private credit. You can take a look at two pitch decks, and one private credit fund could be no leverage on the fund level, conservative LTV, and they lend to borrowers secure, and they lend senior loans secured with real estate. Another pitch deck could be unsecured loans to companies with EBITDA under $2 million. And those are two different beasts, right? You need to know kind of the nuance between the two. It's a wild west out there, and the smaller, the lower the range, the lower on the range of fund managers you go, the more variability there is. Everything on the top range, fund managers who have $15 billion, all of their pitch decks are going to be good. There's going to be some variability in fees. There's going to be some variability in strategy. But by and large, the delta between Fund A and Fund B on this end of the spectrum is going to be much narrower than the delta here.
Here, I think we can find a consumer goods or maybe a car reference where the marketing is very sleek, but we don't always take it for granted, right? That car or that luxury product is not going to make you necessarily more attractive or more successful. We as consumers have adapted to this, but perhaps this is new in terms of the sleek pitches of the private market. But this is also where there's potentially alpha in terms of an investor if you are able to discern between the perfectly crafted pitch and the one that might not be as beautiful, but a better opportunity. I think that's really an important part of the game.
It's sort of like the public markets, right? The larger the company becomes, the harder for them to grow, to generate 15% annual year-on-year growth. Because of economies of scale, for a company that has $1 trillion worth of market share, it's really difficult to acquire anything that will move the needle versus a small, nimble company. So when you have a small sponsor who's nimble, who can take advantage of those $1 million opportunities, it's not going to move the needle for Blackstone. A $1 million deal, even if that $1 million deal generates a 3x multiple in 2 years, is not going to do anything for Blackstone, but it's going to be very difficult for Blackstone to go and take advantage of that opportunity because it's too expensive. On the smaller range, but once I started writing, from the feedback that I was hearing from investors, it was, okay, well, yeah, I trust your opinion. Will you take a look at this deal? Half of my inbox became, hey, there's this interesting deal. I would like to take your take. And I was sitting there and thinking, this is not really scalable. There's one of me, and there's hundreds and thousands of deals that people look at, and they're in all these different asset classes. And some of them I wouldn't necessarily have a really good take on, perhaps. So that's where AI came in. I have been playing with it like all of us have been, right, when it first came out in 2022. And the capability just wasn't quite there. It wasn't until the last few months with Notebook LM came on the scene that I was able to find a shortcut. I've been finally able to do something. I've been able to create a mini Leyla. I call her mini Leyla. It's just a series of prompts where I can take a pitch deck, throw it into an LLM, and prompt an LLM to analyze it. The reason why I spend so much time writing about it now is because I really truly believe, that is the unlock for the dentist who's about to retire, who knows nothing about industrial real estate in Nashville, Tennessee. It is the unlock for that dentist or whoever that is. I'm not picking on dentist, but it is the unlock for that investor to finally have somebody in their own pocket that doesn't cost anything. It's finally the unlock for another set of eyes that's unbiased, that can ask good questions, that is always available, that will at least prod them to think a little bit deeper, a little bit beyond the deck. Think beyond the deck, right? If you, as somebody who used to sell stuff, when you sell things, you present a certain point of view. And I'm not saying that sponsors mislead investors, but they'll highlight certain things in the deck. I'm yet to see a deck that says, oh my God, I came to this market and I hated it, but we have to do a deal. Nobody's going to put that in a deck. When I first started, obviously, when you start writing anything, when you start putting content out, it's the number one question is, how do I get people to look at it, right? How do I get in front of the audience that I want to get in front of? And it's kind of, that launched my social media career. I was not on social media at all up until last year. I've been on the two platforms, on LinkedIn and Twitter, for about a year. And it was a very steep learning curve. I love social media. I can talk about it for days. I think that is, for anybody who puts content out, yourself included, George, I think that is the key to get in front of your audience, to get to the right person. Because if you hit the right person at the right time with the right piece of content, they will follow you, right? Once they follow you, they see more content from you, and hopefully they start consuming your longer form, kind of deeper pieces. The memes, I adore memes. I love it. I think you can say a lot in an image. I'm all about democratization of knowledge. To me is giving the knowledge to the right person in the right format. And I can tell you this right now. For background, I do have a degree in finance, but many moons ago, my very first college degree is actually in philology, in English and French. I read my way to a college degree. I absolutely love reading. I read a lot of fiction. I love fiction. I used to write long essays about things like Voltaire, but nobody has the time for that. And I say this as somebody who loves books. I love long form content, and it pained me for a while that nobody has the patience to do it. Nobody would read it. But now I've embraced it. I'm like, okay, if I could hit somebody between the eyes with a funny meme on a topic that's near and dear to their heart, and if that's what it takes for them to read my longer form content, so be it. Good memes, good funny stuff takes hours to write. The good stuff, the good short punchy stuff takes me longer to write because it takes years of background knowledge distilled into 2 lines that will come and hit you at the right moment in the right way and stop you from scrolling past. And I think we talk about serious things, right? We're talking about important big funds and we're talking about lots of money here. But at the end of the day, I can have the most intelligent things, and I see it all the time. I see super intelligent people with outstanding content, and they can't grow because they can't deliver it in the right way to the right audience. It breaks my heart. Nobody reads the long stuff. Nobody does. But you know what? It's the world we live in.
Yeah, this is such an important lesson and also so relevant to this particular space that I'm involved with, in B2B fintech, where some people really have solutions that can have a dramatic impact and decrease the cost of investing. But it's a complicated thing. How do you break through? How do you get people to listen? This is also something that I discussed with an academic and author, Alex Edmonds. You have to capture and earn the attention of the people, and then there's a lot more you can do from there. We've learned so much on how to approach private markets, but also how to approach content in complicated industries, such as private markets. So I'm very grateful, Leyla, for your participation to the podcast. Please tell people how it's best to connect with you and keep learning.
Yes, and thank you, George. It's been a pleasure. Thank you for having me on this podcast. And for all the listeners, if you want to read the case studies, I have a bank of them, of about 40 case studies across different asset classes. You can find it on accreditedinsight.com or find me on social media. I love memes.
Thank you so much, Leyla. And we will add all those links to the description so you can access them to one click. You can subscribe to the Accredited Insights podcast Substack for free, and you can get a lot of value from it. And many posts are not behind the paywall, but if you're seriously considering dipping your toes or becoming a sharper LP investor, then I would expect that you'd get a lot of value by becoming a paid subscriber for just £8 a month, or even less if you get it yearly. Thanks very much, everyone. And just a quick ask, if you're listening to this on a podcast platform, if you could please leave us a review on Spotify or Apple, I would really appreciate that, and it would help more people discover this podcast.